Let's talk about loans for your business. Now I'm going to go through a list. It's not an exhaustive list. There are lots of loans out there, but these are the ones that I see most often in the market. Something to know about all loans is they may have a security interest in either your personal assets or the assets of the business, or potentially no assets. Make sure you know what the interests are of the loan that you're looking at. Also, try to match the loan with the asset. So for example, if you're getting a short-term loan, you should only use that for short-term assets, inventory, AR, things like that. If you're getting a long-term loan, you can use that for long-term investment in the company. So you should try to match the cash flows of the loan with the cash flows of the assets. With that, let's get to it. The first type of loan is an SBA loan. Now you've probably heard of these, and if you're a small company and you're eligible, you can certainly try to get one. They're sometimes easier to get than other traditional loans because the SBA partially guarantees them, so banks are more willing to make them. So Wells Fargo, Bank of America, institutions like that would make these sort of loans. And there are two types. There are working capital short-term ones, and there are long-term loans under the SBA umbrella. So make sure you get the right kind for you. Expect a voluminous amount of paperwork, a little longer to get it done, and to jump through a ton of hoops to get these loans done. But that's an SBA loan. The next type of loan is an asset-based loan. And these loans are more short-term in nature, and they're tied to specific assets in your company. So for example, if you have an invoice that you need cash on because you haven't collected it yet, or you have inventory that you need to buy inventory and then you're going to sell it and turn it into cash, then these types of assets, you make an asset-based loan secured by these specific assets. These asset-based loans are normally repaid with the cash from these assets. So if you sell the inventory, you have to repay the loan. If you collect the receivable, you repay the loan. And that's sort of how that works. The next type of loan is a revolving loan. And these are similar to asset-based loans in that they are normally tied or pegged to short-term assets. But instead of being repaid with specific activity in the business, they are just pegged or monitored against assets. So for example, if you have $100 in inventory, you may be able to borrow 80% of that inventory in a loan. So I may be able to get an $80 loan against my $100 inventory. Now, the revolving loan doesn't care what inventory is in there as long as I have $100 to support my $80 loan. Likewise, I don't have to pay the loan back with specific inventory cells. I can pay it back as I please, or I can borrow as I please, so long as I have the adequate assets to support the loan balance that I'm trying to carry. That's a revolving loan. The next type of loan would be an equipment type loan, an equipment financing loan. And unlike the first two, they're most often done with banks, more traditional financial institutions. Equipment leases or equipment loans are done normally with financial companies, not with banks. And they're a little more expensive and they're more flexible. So if you have a specific piece of equipment you're trying to get for your company, like a big piece of machinery or a vehicle or something like that, you may be able to get an equipment facility or equipment lease or loan. And the payment terms will be tied usually to the life of the asset, and you'll pay back the loan over the life of the asset. And they may have unusual terms at the end, so make sure you're aware of what those are. Do you own the asset at the end? Is there a balloon payment at the end? Do you have to pay something in to get the asset? There also may be agreements like maintenance agreements and service agreements, things like that, that are also benefit tied into these equipment loans. The next type of loan is a term loan. And term loans are longer in nature. So if you were to make a term loan, you might repay it over 36 months or 60 months or 72 months. And you might have straight line payments, more like a car loan, right? That's like a term loan, sort of. And you may even have some deferred payments for some period of time. And these loans are made by banks as well as some other financial institutions make these. So they're a little harder to get sometimes. They have a little higher credit threshold because they're looking at the total operations of the business, not a specific asset. So be aware that they are sometimes harder to get, but very useful for long-term investment in the company. The next type of loan is called a venture loan, or sometimes called a levered loan. And these are similar to term loans in that they're often longer term in nature, and you have flexible repayment schedules. It may be even 6 months plus where you don't have to pay any principal back. So that's good. They're a little more expensive. They're offered by banks sometimes, but usually by finance companies of some sort, and they may be twice or more expensive than a traditional term loan. But they're flexible in that you don't have to have the same level of credit that you would with a term loan to get a venture loan or a levered loan. So you can have a little less than savvy credit. But if you have good assets, or you have a good investor base, or you have something attractive, high growth trajectory in your business, then you may be able to get one of these types of loans. Be aware that they, not only are they going to be more expensive from an interest perspective, but they may have equity-like terms in them. So they may get stock or equity-type assets in your business in exchange for giving you these loans. And that's how they reward themselves for taking on additional risk with this upside in your company when you sell it or exit or whatever you do with it, right? The equity. The next type of loan is called a convertible loan. And that is something that you use usually with friendly parties, people that know the company, know the business, and maybe future investors. And so you'll get a convertible loan when you have an event in the future, an equity event in the future. So you're going to take an equity investment and you see it happening, and it's 6 months out or 3 months out or 9 months out or whatever. But it's in the near term, or maybe a year out. And these loans will be given to you. They look like normal loans, but when the equity event happens in the future, these loans will convert into that equity. Right? They'll turn into equity, and so they'll no longer be loans. And so oftentimes the interest associated with these loans is also accrued and converts into equity as well. And that's why they're often friendly parties, people that would like to invest in the equity, but for whatever reason you're not doing the equity round today, and there are a lot of reasons why you would do that, but that's what these types of loans are, convertible loans. They also, as a note, may have favorable terms versus the equity, right? So they may convert at a discount or carry some other terms that are favorable to incent the people to give you these convertible loans now instead of waiting for the equity event to happen. The next type of loan is called a bridge loan. And these loans happen when by friendly parties usually, and they happen when you have an event similar to the loan we just talked about, a convertible loan. But with a bridge loan, you have an event happening, and it may be a loan that's going to happen, or maybe equity that's going to happen, and you know it's going to happen, but you need a bridge for some amount of time, 3 months, 6 months, 9 months, not long usually, less than a year, pretty for sure, a bridge loan. And you'll get these from friendly parties, and when this transaction occurs, this bridge loan will be paid off immediately before anything else happens. So that's a bridge loan. So again, this is not an exhaustive list, but these are some that I see most often in the market. Hope this was helpful.
For more training and tips just like this, visit us at TrueSpanFinancial.com.